Welcome to the Investing Markets and Money podcast brought to you by the Armchair Trader. This week we are talking big picture, and on the podcast we have Aneeka Gupta joining us from WisdomTree, where she is the Director of Macroeconomic Research. Thanks for joining us this morning, Aneeka.
It's my pleasure, Stuart. Thank you so much for the opportunity.
So nice to have you on, because there's quite a lot of big themes playing out in the markets at the moment, which everyone seems to be extremely focused on. The first of which is the drop in inflation figures in some major markets and the reaction of some of the central banks to that. Are we right in thinking that this is the end of the inflation, which has kind of been dogging the steps of many investors for the last couple of years?
I think it's a really pertinent question. I think most of the data prints that we've been getting globally is showing that inflation is on the correct trajectory. Central banks have rightly tightened monetary policy over the prior 2 years. Since the COVID pandemic and the Russia-Ukraine war that resulted in energy shock. However, I would say that we aren't completely out of the woods. There's always this unknown risk lurking in the horizon. If you reflect over the past week, we've had escalation of tensions in the Middle East, and that has resulted in a very quick price reaction on the energy markets, and does pose a risk for elevated energy prices depending on how that scenario plays out. We've also had supply disruptions in the U.S. with these port strikes. We have seen a little bit of a temporary resolution come into effect, but that issue is going to be brought back onto the table in January of 2025. So I would say the fact that energy prices continue to pose a risk, supply disruptions are also lurking in the horizon. We still haven't completely solved the inflation battle. We do believe that we are in an environment where inflation has come down materially, aided by the central bank reaction, but we're not completely out of the woods yet.
And I was on one of the online brokerage platforms this morning, looking at the top traded stocks. 4 out of the 5 for their clients are still Magnificent Seven trades. This is a really crowded trade, which has been very, very persistent. Investors have been rewarded with some good returns. But from your perspective, and this is a question I ask a lot of people, what do you think is going to be the outcome from this, and what sort of catalyst could affect this? Because I don't feel like it can go on forever.
Yeah, I agree with you. We've seen that in past tech cycles where we achieved that. You see equities trade higher over the boom period, and then you reach this peak point, and then you enter the bust phase of the tech cycle. I think the Mag 7 have rightly been awarded with much higher performance on the back of higher uh, equity growth, in their earnings growth that has taken place. However, I think what seems to be quite interesting is we're now entering this period where the earnings per share growth premium of the Mag 7 versus the remainder of the S&P 500 is beginning to shrink. So, in the first half of 2024, they had a very large gap if you looked at the earnings per share growth versus the rest of the S&P 500. And as we move to 2024, that is expected to shrink further. As we move into Q1 of 2025, that's supposed to be shrinking even more so. And that is what the equity markets are anticipating. They're anticipating that shrinking of the earnings growth premium between Mag 7 and the rest of the market. And they're trading on that, which is why if you compare the equal weighted S&P 500 versus the Magnificent 7 or the market cap weighted S&P 500, we've already seen it outperform in Q3 of 2024. And that's precisely an indication of how the market is forward looking. It's trading that forward looking indicator, which is showing a shrinking of the earnings growth premium between these two segments.
And we talk a lot to fund managers and investors at the Armchair Trader, and one of the things they've been talking about a lot is the small caps market, and that's really been heavily oversold. Beginning to see some signs of life, but again, could be a false dawn. There are a lot of very gloomy people there with a lot of small caps in their portfolios. Do you think they're looking oversold at the moment, and do you think we might see a renaissance soon?
Yeah, I think we are definitely seeing we identified that opportunity just to the point where we drafted our outlooks. I had drafted the equity outlook. Breaking equity market concentration, is presenting a plethora of opportunities in the equity markets, and one of those segments was in the small cap segment of the equity market. And if you reflect on history, since the creation of the Russell 2000 index back in 1978, small caps have only been this expensive once before, and that was in 1998 to 1999. And that actually preceded a 11-year stretch of small cap outperformance. So it's worth reflecting on that period of time because we have never seen small caps this discounted to the large cap segment of the market. And I think what's aiding the recovery of small caps is also quite important. Historically, we've seen small caps actually benefiting during periods of declining inflation and in those early stages of the Fed rate cuts. And as we've rightly pointed out, we are seeing inflation easing, and we are seeing markets pricing in potential cuts for 2024 and 2025. And smaller caps just appear to be in a more opportunistic environment than existed, over the last few years. Small caps also historically have outperformed large caps by around 10% on average in the first 12 months following an initial Fed cut. Um, and obviously, given the fact that uh, small cap companies hold around 42% of floating rate debt, this will contribute to a crucial factor in their value creation equation. So I believe that these factors just provide those necessary catalysts for that recovery in small caps, and that's why we do see opportunity there.
And at the time of recording, we are about a month away from the US elections. How do you see that campaign? Obviously, only a few weeks left, but how do you see that campaign and its outcome affecting US stocks overall?
Yes, it's really critical. We're To put it in numbers, we're 27 days away, Stuart, from the U.S. elections, and the focus is going to be very much on how each candidate presents themselves and is able to actually win the electorate. I think if we look at the impact of U.S. elections on a whole, what we've noticed is in the run up to the U.S. elections, the S&P 500 returns have been a lot stronger. In fact, it is post the US elections that we generally tend to see, after election day, we actually see the US stock markets trade meaningfully lower, compared to the periods prior to the actual presidential election. But if we try to focus our attention more on each candidate and what they're proposing, in the case of Trump, I think the centerpiece of Trump's 2024 agenda is an extension of the law that he passed in his first term that lowered business and individual tax rates. And those are due to expire in 2025. And so, Republicans say that it's their number one priority, that if they win the White House and Congress, they'd likely be there'd likely be bipartisan support for extending some of those cuts, especially for middle class households and small businesses. Trump also has said that he wants to lower the corporate tax rate further to 15% from 21%. And he's promised more and more tax breaks, from exempting tips and overtime pay to reversing a cap on state and local deductions that he himself had imposed. Um, so that seems to be front and center in Trump's campaign. I think the other key factor is Trump's tariff plan would essentially uh, be very negative from a U.S. and China trade standpoint. It would essentially virtually end U.S. China trade, and his proposed crackdown on the border and deportations could also knock off more than 3% of the GDP by the 2028 election, according to our calculations. Now, on the other hand, Harris's proposals are a lot more modest. She is showing a new willingness for the government to wade into the markets from real estate all the way down to retail. And I think the other key factor is, besides the tariff announcements from Trump, he's also promised deregulation for the traditional energy companies, banks, and financial services. So for the banking giants in particular, the hope is that Trump 2.0 could see some of the unwinding of those strict Dodd-Frank regulations that were imposed at the peak of the financial crisis in 2008. So, those are some important implications that could be quite an important catalyst for U.S. equity markets.
In your recent paper you wrote for WisdomTree about global equity markets, you mentioned emerging markets as well. Is this something that you think could become a big area of interest for investors over the next 12 months?
Absolutely. I think, I mean, clearly we have already seen the Federal Reserve embark on an easing of monetary policy. And one of the big beneficiaries historically from that easing of monetary policy and the subsequent weakening of the dollar has been emerging markets. So emerging markets as an asset class have had very lackluster performance over the prior decade. And that largely is owing to the fact that their earnings growth premium of emerging markets versus developed markets has been weak over the prior decade. Now that we are beginning to see an easing of monetary policy by the Federal Reserve, and they've gone on quite aggressive with a starting out with a 50 basis point cuts, that has eased the dollar somewhat. And it also eases liquidity conditions for emerging markets that are issuing debt in dollars. The other key factor is, even prior to this important catalyst for emerging markets, we've seen upgrades by rating agencies, be it Fitch, Moody's, or even S&P, all now on net show an improvement with higher upgrades versus downgrades, which is a sharp shift prior to the COVID pandemic. And that's just illustrative of the improvement that we have been seeing in overall conditions within emerging market economies, that stand to benefit emerging markets as a whole. And clearly, if we even think of growth dynamics, since 2020, if I reflect on some of the numbers from the International Monetary Fund, um, you know GDP in developed markets actually contracted about 3.99%, whereas GDP across emerging markets declined by only 1.7%. And we've seen emerging markets quickly bounce back to growth of around 4%, while developed market GDP has actually remained quite tepid. And so, in addition to the Fed easing cycle, what we believe is that resilience of emerging markets through the pandemic and over the last 2 years has really reestablished a very healthy growth differential, which is likely to be beneficial to the emerging market landscape. Now, obviously, we've had this new equation being added to the mix, where last week we had China come in quite aggressively and announce a monetary stimulus package, which is expected to be followed by fiscal stimulus. But just looking at the monetary stimulus announcements that they had made, they've tried to address counter-cyclical measures, additional measures targeted to the property sector, as well as an equity stabilization fund. So it's quite a comprehensive package. They also held a Politburo meeting in September. That's the first time we've ever seen a Politburo meeting taking place in the month of September, which does draw global investors' attention to the need for urgency to act, to try to bring around a change in the existing situation taking place in China. And so that also contributes to an important catalyst for Chinese growth dynamics. In addition, we've been seeing emerging market investors actually move to look at growth just beyond China, with India dominating the landscape, as well as South Korea, owing to its strong success on the technology side. The AI boom has been a very important driver for Taiwan. We've seen AI related demand for has contributed quite extensively to exports for Taiwan and helped in gross capital formation. And even in Latin America, which was one of the weaker links within emerging markets, last year we've seen them be some over the prior 2 years since the reopening of the economy from the COVID pandemic. We've seen them actually be big beneficiaries of the reshoring dynamics that have been taking place, be it Mexico, Chile. They've all been benefiting from the China plus one policy and the reshoring dynamics that have been taking place. And obviously, Chile has been a big has seen a benefit of being a very important exporter of key commodities, including copper, which has been quite crucial for the energy transition. So I mean, the opportunities and within the economies of emerging markets, there are numerous opportunities to cite beyond China, and now with China coming in with their policy stimulus, it just adds a bit more momentum to the emerging market stories for the long run.
And sticking to emerging markets, I just wanted to get your view on India, which has probably been one of the more profitable emerging markets trades over the last year and a half, and certainly it's done well for me. I've been talking to a couple of India fund managers who are now worrying a little bit that things are starting to overheat. Certainly the IPO market there is just running red hot at the moment. What's your view on the Indian market?
Well, I think India, as within the emerging market landscape, has been one of the more expensive markets with higher valuation, and that's primarily because of its higher growth opportunity. I think if you look at today's environment, it's really been all about the government providing a lot of support to the overall GDP dynamics, and this is primarily rooted in the fact that the government, wants to make infrastructure development a central focus of transforming the Indian economy and transforming it in a way to a size of a $30 trillion developed economy by 2047. And so they are embarking on the path of infrastructure development being the key solution to this initiative. We've seen the government had previously launched the National Infrastructure Pipeline in 2019, and the vision there was to invest $1.5 trillion over the next 5 years up until 2025. Now, this initiative currently supports, more than 9,000 projects, and we have seen the scale of infrastructure improvements underway, and that's really led to that broad economic expansion. Now, if you reflect on the newly formed government under Prime Minister Modi, they recently presented the union budget for 2024, and again we've seen that focused on 9 key priorities in the pursuit of fulfilling the Viksit Bharat 2024 vision. And again, the vision is to transform India into a 30 trillion developed market economy by the time that it attains its 100th year of independence. And the focus is prioritizing economic growth, social progress, alongside sustainability and good governance. So that is really coming into the into the focal uh, point really coming into focus, I would say. Now, one of the reasons actually is, if you try to understand what is the, obviously, developing that infrastructure is extremely important, but one of the reasons behind that is because, according to a government survey that was conducted in 2022, India's logistics network actually generates costs in the range of 14 to 18% of GDP. So it is extremely unproductive if you compare it to the global average of 8%. So this is one of the reasons the government is targeting, further infrastructure development to try and gradually eliminate these inefficiencies. And the plan is to at least halve logistic costs that contribute to so much of lower productivity by 2028. And I think that is a very important mindset to keep in mind, that they are trying to target an inefficiency that exists by putting into place this grand vision of, higher infrastructure, which will gradually allow, a lot of the rural networks to also have access to, the mainstream parts of India, benefited with this higher infrastructure development that is taking place, which, I believe will be quite crucial. So that's why we still remain very optimistic on India from a growth standpoint, and also the continuation of political stability that currently exists.
I know I'm jumping around a bit on this one, but on your paper you wrote, you looked at Europe as well, European equity markets, and it sounded a bit like you were encouraging investors to see Europe from a sector by sector approach. Are some European sectors looking more vulnerable economically than others? Are we going to see some winners, some losers, if you break it down that way?
Absolutely. What Europe is facing right now is, we are seeing growth activities waning. We are seeing most of the heavy lifting on the GDP front taking place from the south of Europe. So the south of Europe is becoming a lot more productive, a lot more efficient, and they are actually overpowering the north of Europe, which, traditionally has not been the case. And the waning growth activity that is taking place in Europe overall, is now becoming more of a concern as compared to inflation. In fact, if we just reflect on the recent September inflation print, we are now seeing inflation come well below the European Central Bank's 2% target. And hence, the focus really is about restoring growth, and aiding some of that stimulus to come into the European economy. And so that is just allowing and opening up the case for the European Central Bank to be a lot more accommodative in their monetary policy stance. And we believe that is likely to pave the way for a lot more easing from the European Central Bank, and asymmetrically benefit certain segments of the economy as opposed to others. So, for example, the small cap is likely to benefit at the cost of the large cap segments. And from a sector perspective, we believe software, communications, real estate, defense, I would say pharma and biotech would be some of the sectors that are, able to benefit from a sharper easing cycle than we previously anticipated.
And Japan, again, another very successful trade, being long Japan up until recently. Looking forward, what do you think is going to be the main driver for the Japanese equity markets? Is it going to be the yen, or do you think it's going to be the ongoing efforts by the Japanese government to roll out some fairly wide-ranging corporate government reforms and make that equity market more efficient?
So I think the central factor that's going to be driving the Japanese economy is going to be uh, growth of capex. So the reinvigoration of capex by Japanese corporates is what's going to allow Japanese growth to continue at quite an aggressive pace. Now, the reason for that is, ever since they've opened from the COVID pandemic, they've seen much stronger consumption, uh, higher demand from Japanese investors. We've seen aging demographics pose quite an important threat, and so we're seeing, higher capex taking place from companies in order to replace some of that portion of the workforce that will no longer be able to participate in the labor markets. And so, that we believe will be the most important driver for growth going forward. In addition, given the fact that Japan has such a high share of exports globally, the trajectory of the yen remains an extremely important dynamic for the Japanese economy. And clearly, for the last 2 years, we've seen the Japanese yen weaken quite aggressively versus the US dollar. On average, it was trading around 150 yen versus the dollar. However, over the past month and a half, we've had quite a sharp turn in sentiment and market movements with uh, a much weaker labor report back in August, allowing the Fed to ease policy a lot more aggressively. In lockstep, we also had the Bank of Japan around the same time increase rates for the second time since it began its monetary tightening cycle. And that just paved the way for the yen to appreciate quite considerably. For us, I think now that we've had the new elections by the Liberal Democratic Party, and with Prime Minister Ishida taking the helm, he has also sent some very important uh, sent some very important communication to the market, where, despite the fact that he was previously perceived as being a more hawkish member and adopting a more hawkish stance towards monetary policy, he's actually cleared a lot of the ground and said that Japan isn't yet ready for such a sharp shift in rate hikes. Given the fact that it is holding a large amount of debt, and that would be extremely costly for Japan. And so we still believe that Japan's growth trajectory, needs to be managed in a much more cautious way, and hence the Bank of Japan, along with the government, will be quite careful on how they, pave the way for monetary tightening as they move forward, because they will need to try to balance the growth and inflation dynamics, and also mention that they and also try to ensure that they don't spoil or hurt their competitive ability, which has been so strong over the prior 2 years on a global landscape. And so we still remain very optimistic. If you look at the recent Tankan survey, corporate guidance for the main corporate FX assumptions by Japanese corporates has been around 144 yen per dollar. And if you take into account for the fiscal year 2025, the yen has traded within that range, and hence we believe that Japanese corporate guidance should not have to change meaningfully, because the yen is still well below the assumptions that they had already factored in to their calculations. So we still remain very optimistic on Japan. Obviously, the corporate governance reforms have been a very important catalyst, but isn't the only driver. It's a very important addition to why Japanese corporates are benefiting from these foreign inflows coming in. And that's because we've seen share buybacks reach a record high in 2024. We've seen dividend yields rising, and are getting a lot more competitive when you compare it to US and Europe dividend yields. And so it overall paints a very important lucrative opportunity for foreign investors when they compare Japan, US, China, and Europe, alongside Japan, because not only are you seeing better shareholder returns, but you're also seeing earnings growth momentum rising. In fact, if you look at the three month earnings revision ratio. It's actually the highest for Japan, even higher than the US, Europe, or even the rest of Asia. So we still remain very optimistic on Japan. There is tremendous opportunity within the Japanese economy.
Finally, I just wanted to ask you about the gold market, because that seems to be one of the commodity markets that is attracting a lot of attention from analysts and a lot of traders as well. What's the WisdomTree house view on gold right now?
Well, just like I mentioned, with the Fed embarking on its easing cycle, gold is one of those commodities that stands to benefit. Gold is actually one of the best performing commodities. It's hit multiple record highs, and there've been a multiple number of factors that are supporting this upward momentum that we've seen in gold. So far it's been the factors that have been supporting gold have been the lower bond yields as a consequence of expectations of interest rates to fall in the US. So lower bond yields have lowered the opportunity cost of holding gold because gold is a non-interest bearing asset. In addition, we've seen the dollar ease that has also lent an important tailwind for gold. In addition, we've now started to see, buying of gold, so physical purchases of gold by central banks globally have started to rise. So, China in the first half of 2024 saw record purchases of gold. Towards the end of June, we saw India buy extremely high amounts of physical gold, and that is because the government lowered the import tax of for gold imports coming into India. We've also seen Turkey increase their gold purchases. And so the gold market is getting a lot of support from the physical market and the physical buying that is actually taking place. A new catalyst that has emerged has been inflows into gold linked ETPs. Now, historically, when gold prices rose, inflows into gold linked ETPs automatically rose as well. But since the Russia Ukraine war, we've actually noticed a downward trend, despite the fact that gold had been rising. Inflows into gold linked ETPs were actually falling. And hence, we were not able to get that any momentum coming through from the ETP market. However, since June, we've seen 10 consecutive weeks of inflows coming into gold ETPs from the US as well as Europe. So that's a new catalyst that is aiding the gold market. So, in the long run, I think the direction of travel for gold remains higher. In fact, the World Gold Council, conducted a survey among central banks globally in June of 2024, and what they observed is this was one of the first years where we had more than 80% of central banks intentions for the second half of 2024 was to increase their gold purchases compared to the prior years when they've conducted these surveys. It has actually never been this high.
No, very exciting times for the gold bulls out there. Thank you very much indeed, Aneeka, for coming on the podcast. I know I've asked you lots of different questions about a wide variety of different financial markets, and it was very insightful and what you were able to tell us. But thank you very much, Aneeka Gupta, Director of Macroeconomic Research from WisdomTree.
It's my pleasure.
You've been listening to the Armchair Trader podcast. Make sure you visit our website, www.thearmchairtrader.com, for your daily dose of financial markets news and sign up to our free newsletter there.